this isn't just volatility in my mind. It's the market exposing the shortages of physical silver, the frailty of the paper promises. This is something that I think is just beginning. And there's just far more demand for physical silver than there is the availability. And the paper system is beginning to show great strains. People have accepted paper promises for a very long time. And I think that's coming to an end. And look, this is decisively bullish for silver and other precious metals.
Andy Schectman explains that the silver market is experiencing unprecedented backwardation, revealing extreme delivery stress and a shortage of physical metal. He argues that the paper-based trading system is breaking down, with massive leverage, about 2 billion ounces in paper claims against just 140 million ounces of real silver in London. Lease rates for silver have surged from around 1% to over 39%, showing how costly it's become to borrow silver for delivery. Buyers now demand physical metal instead of rolling paper contracts, exposing the system's fragility. Schectman believes this shift will drive silver far higher, potentially reaching $75 to $100 or even $96 as the market transitions from paper speculation to physical ownership. He concludes that this reflects a broader global move away from the US dollar and toward tangible assets, mirroring how China and BRICS nations have accumulated gold and commodities, while the West relied on debt and service economies.
I've never seen anything like this. This is the term that everyone keeps throwing around is the word backwardation. Backwardation is an environment that shows extreme delivery stress. It's unprecedented. This isn't just volatility in my mind. It's the market exposing the shortages of physical silver, the frailty of the paper promises. This is something that I think is just beginning. And there's just far more demand for physical silver than there is the availability. And the paper system is beginning to show great strains. People have accepted paper promises for a very long time. And I think that's coming to an end. And look, this is decisively bullish for silver and other precious metals. But I think it's beginning to show that the paper promises that this whole Western system has been based upon is starting to break. London, they have a 140 million ounce float, yet they're trading 600 million ounces a day in contracts that technically are deliverable. What could possibly go wrong? There's over 2 billion ounces in paper claims out there on a float of 140 million ounces. So that's exactly what it is. It's a situation where the paper promises, this rehypothecation is being called on the mat. And you can see that. Look, for example, the lease rate in silver in London, when you lease silver in London, it would be something like you want to short a contract. You want to short the price of silver, but you don't have the metal. So you have to borrow metal through leasing it in order to deliver the metal to drive down the price. Normally that lease rate is somewhere in the neighborhood of 0.5% or 1%. In October, it's jumped up over 39% to over 39%.
Wow.
And at the same time, we've seen silver rise since August when the lease rate was at about 1% or so, up to $53 here. So you see the price rising, the lease rates rising. We're seeing the exact same thing in platinum, but it's a situation where right now you have the spot market trading well above the futures price. In other words, buyers are very desperate for immediate delivery. And it's very rare to see this, Adam, in silver. Yeah. It's very rare. It signals urgent demand, depleted inventories, and really a systemic shortage of deliverable bars. And that's all because of rehypothecation. In other words, it's getting called onto the carpet.
Okay, and where is this shortage really manifesting most? Is it in London?
Absolutely, it is. I mean, you're seeing delivery stress on that is exacerbating it on COMEX. We've already seen 16.5 million ounces delivered in COMEX, adding to the limited vault supplies. But yes, the main stress is in London right now, and much more so than on COMEX. And really, it is, in my mind, the epicenter of where all of this could really get into some serious problems where you're beginning to see margin calls for traders out there who are receiving a margin call because the price is going against their short position and the lease rate and the borrowing costs are so high that they're not able to get the silver to cover their position. And that's when things begin to get very, very, very interesting. What it really tells us is that buyers aren't just rolling over their contracts like they used to. They're standing for delivery. They're demanding real metal. And these delivery numbers are well above normal. So I guess if you could encapsulate it easily, it's that the rush for gold and silver is real. It's intensifying. And markets just aren't trading paper contracts right now. The people want the real metal in hand. And in a world where paper contracts are vastly overstating the supply, the short-term implication would be liquidations and survival-driven selling can trigger volatility. That's the short term. Even sharp pullbacks. Medium term, as far as I'm concerned, is that once this forced selling ends, the physical scarcity starts to dominate and silver sustains its higher prices, $50 plus. But long term, if confidence in this paper system collapses, like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. $75, $100. And I say that to you, and that's not pie in the sky, because if you take the 45-year cup and handle that goes like this, the way technical analysis works is the top of the cup 1980, the bottom of the cup the early 90s, and again back up to 2011 again, which is near the top of the cup, and then formed another. It's a double cup and handle. But the way that it works is once silver has broken through 50, which it has, technical analysis would say you take the distance from the bottom of the top, which was $46, from 50 to 4, and you add it to the top. That would mean that the next target from a technical analysis standpoint is $96. And I think that's exactly what you will begin to see, where the market physically begins to exert itself over the paper shenanigans that we've seen for a long, long time. The United States for the last 40, 50 years has bet on a strategy of strong dollar and U.S. bonds and service jobs, where the rest of the world, in particular the BRICS and China, have, you know, have not been ignoring the factories like we have not been ignoring commodities like we have. China, as a good example, did the opposite. It built factories, accumulated commodities and gold, and now is really pushing away from relying upon the dollar. That is ultimately, I think, where we're going. Yes, exactly that, right there.
Andy Schectman explains that the U.S. government is deliberately pursuing a dollar devaluation strategy through policies like the Genius Act and the stablecoin bill. These measures allow trillions of dollars currently parked at the Federal Reserve to flow into treasuries, effectively monetizing debt and weakening the dollar. According to Schectman, this is part of a broader plan, what he calls the Mar-a-Lago Accord, to make American manufacturing competitive again by abandoning the dollar's global reserve status. He highlights that Trump may plan to peg the long end of the Treasury market to gold around July 4th next year, aligning with the U.S.'s 250th anniversary. This move would quietly allow gold to rise steadily, devaluing the dollar without explicitly admitting it. The intention isn't to make gold investors rich, but to restore U.S. industrial strength by lowering borrowing costs and making exports cheaper. Schectman notes that the dollar has already fallen about 11% this year, while gold and silver have surged, gold up 55% and silver nearly 70%, reflecting the currency's decline rather than just rising metals. He argues that central banks and institutional investors understand this shift, accumulating gold and silver as protection against the dollar's erosion. He warns that the U.S. reserve currency status has become a liability, making imports cheap but destroying domestic production. To rebuild, America must devalue its currency and bring back manufacturing. Schectman believes this transition will catch most people off guard, first with rising precious metal prices, then with a sudden shortage of available physical gold and silver once the broader market realizes what's happening. He concludes that owning gold and silver is not speculation, it's preservation of real wealth in a system being intentionally restructured. The coming years, he suggests, will reveal a major economic shift as the dollar loses its dominance and tangible assets become the foundation of value once again.
This is the dollar devaluation trade. This is exactly what I said on your show, where they're using the Genius Act and the stablecoin bill to not only to fund the treasury market, but think of the $3 trillion that's held up and holed up at the Federal Reserve, right? All of this money that's been created by the banks that they don't want to lend out into a fractured economy, so they leave it at the Fed. They're going to now pile all of that into treasuries, into the stablecoin bill, the Genius Act, and this is going to devalue the dollar. Keeping your wealth in dollars is the surest way to go broke. This is what they want to do to bring back manufacturing. That is the Mar-a-Lago Accord. They want to devalue the dollar against assets in order to make manufacturing more competitive. And Judy Shelton was just on my show again. Actually, Michelle McCory did it this time. She runs our YouTube channel as well now, and last week she said it again that Trump is going to peg the back end of the Treasury market on July 4th next year. It's a big day for him. It's the 250th anniversary. If they back the back end of the Treasury market with gold and let gold slowly, like Luke Groman says, let it go higher, 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 higher. And yeah, there'll be volatility, but it keeps going, and no one acknowledges it. Everyone says, "Oh, it's FOMO or it's going to crash." But what if it's part of a bigger plan? By letting gold go higher, you're not doing it to make my job easier. You're doing it to let the dollar devalue. Why would you want the dollar to value? Ask Stephen Mirren, the architect of the Mar-a-Lago Accord. To sell manufacturing. How do you sell manufacturing? You abandon the reserve status of the dollar. You don't give up on the United States, but you abandon the reserve status on the dollar by letting the dollar collapse. It's down 11% in value already this year and falling as gold is moving in the other direction. If you peg it to the back end of the bond market, and in Judy's book, she says 5, 10, 20, 30, and 50, with 30 and 50 having a very small coupon, very small. But if you do that, you can now bring back manufacturing at zero upfront borrowing costs and sell your product to the world at a massively devalued dollar. This is what they want to do. And so when you see gold and silver going higher, it's not gold and silver going higher. It is the dollar losing ground and losing value. And the big money understands this. The big money understands this inherently. And this is what they have been doing. The central banks understand this. This is why they have been taking positions in gold and silver the way that they have. I think this is just the very beginning. So, yes, you're going to see pullbacks. You will see volatility. Nothing goes straight up. But I would agree with you that ultimately it is a buying opportunity. And I try and say this without coming across as being a snake oil salesman. I don't care if people rush to buy metal from me. That's not what this is about. It's about trying to convey something that I believe in my soul is happening. We have reached a point where being the world reserve currency, even ask Vice President Vance, who has come out and said so, being the reserve currency is no longer a benefit to the United States. It's a detriment. It's a benefit to us consumers. It's a detriment to anyone who produces anything. And in order to continue to move forward as a country, we need to reshore manufacturing. And the only way to do that is in a devalued dollar and at very low upfront borrowing costs. The Genius Act will keep rates low on the front end of the curve and fund the government. The pegging of gold at a much higher price, regardless if they revalue it or not, which I think they will, I think they'll just let it keep on going higher slowly, and no one notices it, right? No one is taking action because they're waiting for the other shoe to drop, and it always has. Will it continue? I don't know. Gold's up 55% this year. It's on pace for its best year ever. Silver's up almost 70%. And I do think that commodities will now be a reflection of a declining dollar. It's not that the commodities are going parabolic just because. It's because the dollar needs to be devalued in order to reshore manufacturing. And if there's nobility in what President Trump is trying to do, if I'm reading this right, it is the realization that we cannot continue to be the world's superpower without manufacturing anything, with being reliant on the world for everything. And ask yourself this: if the Congressional Budget Office, has come out and said by 2031, 100% of all tax revenue will go just to pay the interest on the debt, right, and mandatory entitlement, how do we continue to fund our military to rule the world when military spending is discretional? Yes, this is all together. Buying gold and silver right now you're not buying it to get wealthy. You're buying it because it is wealth. And the biggest money in the world, the biggest. It's one thing for me to say the central banks are doing it. It's another thing altogether to say the most sophisticated traders on Wall Street, the institutional traders who are standing for delivery left and right, they know what's coming. And I think that's what you follow. We are living in a very tenuous environment. So, yeah, we have a very good supply of product. But again, when you realize that such a small percentage of the public really has any exposure, that can change very quickly. We've been fortunate enough to have the Sprott brokers run all their business through us, where Rick used to be the CEO.
Right.
And one of their brokers, or a few of their brokers, have been placing massive orders over the last several days with us, indicative of smart money, I think, realizing that something is broken and things are changing. So it's not just my brokers, it's not just our business. We work with other people like the brokers at Sprott. And I will tell you that the demand at a level of sophistication that you speak to, the people who you speak to, I would say are far more sophisticated than many of the financial advisors that they would work with mainstream, because they understand the big picture, right? You go to a financial advisor who might be the best in the business, but doesn't acknowledge that the world is the way that all of us think it is. The macro picture, the geopolitical picture, which is so very, very important to understand if that's going to be the backbone of advice that you're given on your portfolio. So I guess all I can simply say to you is that most people are going to be caught off guard by this. And it will go from an environment of high prices that will identify the market to most people, to your people saying, geez, I can't get it easily. It's disappearing. And just like that, it will disappear. So while things are good right now, you get look, let me put it to you this way. Goldman Sachs said, if the market even suspects for a moment that the Fed is losing independence and 5% of the money that's embedded in Treasury shifts to gold, the price will go parabolic, will go well north of 5,000. It's going to go well north of 5,000 because Stephen Mirren is the architect of the Mar-a-Lago Accord, and he is now on the Fed. He was Trump's big advisor. Or even this Bo Hines, who was Trump's crypto advisor. He's now running USA Tether, which is backing the Genius Act. There is no independence. The market is going to catch on. The big money is catching on. The rest of the money will too. And then getting product will be very difficult because we've gone a year without any of these wholesalers or refiners or big importers finding much need to go deep into their lines of credit to secure product because there wasn't any need to. I knew there would be. And whether I was stupid or lucky, I'll tell you that there are very few companies out there that have the inventory that we do right now.
Andy Schectman emphasizes that the situation in the silver and gold markets is unlike anything he has seen before. He stresses that the combination of physical shortages, rising demand for actual metal, and the fragility of paper-based financial systems is creating a profound shift in the market. Schectman explains that most investors are unprepared for this change and will be caught off guard as the availability of physical gold and silver becomes constrained. He underscores that owning precious metals now is about securing real wealth, not speculation, and that this trend reflects a deeper transformation in the global financial system, where tangible assets are becoming increasingly central to preserving value. He closes by highlighting that the current environment is a rare opportunity to understand and act on these shifts before the wider market realizes the scale of the changes underway.